This topic will cover how to prepare the operating section of the statement of cash flows. The operating activities category includes transactions and events that affect net income. You want to make net income on a cash-only basis by reversing non-cash items from income. Currently, net income of a company is on an accrual basis, meaning there are items that are not cash that can either increase or decrease your income. For example, making a sale on account. Under accrual accounting, we will count the revenue when the sale is made, even though we have not received the cash yet. For the statement of cash flows, we only want to show the cash transactions, not the accrual or non-cash ones. We are essentially going to show what our net income is. Then we're going to reverse out all those non-cash transactions so that we can find our net income on a cash-only basis. These adjustments include income statement items that do not impact cash, such as depreciation expense and losses and gains on assets. Other adjustments that are needed are adjustments for changes in current assets and current liabilities, such as changes in accounts receivable, payable, inventory, and others. The balance sheet is needed to find this information. Therefore, we will need information from the income statement and from the current asset and current liability section of the balance sheet. Some specific examples include cash inflows from cash sales, collections on credit sales, receipts of interest revenue, and some examples of cash outflows include payments for suppliers, payments for employees for their salaries, payments for interest owed or for taxes and fines, and for other operating expenses. When preparing the operating section, you always need to begin with net income. Remember, you find this amount from the income statement. This is on an accrual basis, so the next steps are to weed out all those non-cash transactions. Step 2 is to add back non-cash expenses. This is because there are expenses that have reduced income, but since they weren't cash, we want to cancel it out by adding these expenses back. The main one we will deal with is depreciation. You can find depreciation expense either on the income statement and sometimes in the accumulated depreciation account on the balance sheet. There are others that are considered non-cash expenses, such as amortization, but we are really just going to focus on the most common one, which is depreciation. Next, you want to reverse any gains or losses, since these are non-cash transactions. You can find gains and losses on the income statement. Since gains are added to net income, we want to subtract it back out. Since losses have been subtracted to arrive at net income, we want to add the losses back since they are non-cash. My example for why this is done is think of selling a car. If you bought a car for $20,000, then you sold it for $15,000, wouldn't you say you lost $5,000 on the sale? This loss gets subtracted from your net income number. However, even though you lost $5,000, did you actually spend that money? Your cash actually increased by the $15,000 sale of the vehicle. You did not actually spend $5,000 cash. You got money. The loss is a non-cash transaction. This next step is a little more complicated. You need to look at the balance sheet. First, look at the current assets, except cash. Then you want to look at the current liabilities. Not all assets and all liabilities, but the current ones only. You need to use the comparative balance sheets to compare the current year amounts with the prior year amounts to see how much they increased or decreased from last year to this year. If a current asset decreased from last year to this year, you want to add that amount in this section. If a current liability increased from last year to this year, you want to add that amount as well. On the other hand, your subtractions will be the opposite. Any increases in current assets or decreases in current liabilities should be subtracted from the total in this section. After all these items are inputted into the operating section, total a column to arrive at your cash flow amount from operating activities. Let's work on our example. We will be using this information for the other topic videos as well. Use the financial statements and additional information to prepare a statement of cash flows for the year ended December 31st, 2018. Right now, we're only going to prepare the operating section. As you can see, we have a comparative balance sheet that has last year's and this year's numbers. We have an income statement and we have some additional information. The additional information should really just help corroborate the information in the financial statements or add some more color to the types of transactions. Before beginning the statement, it makes it easier to find the changes on the balance sheet from last year to this year. On this slide, I have just the balance sheet and an additional column to write in the change from last year to this year. For example, the cash had $30,550 last year, but now has $30,400 this year. What happened from last year to this year? It decreased by $150. All you need to do is to take the current year amount and subtract the prior year amount. I'm going to put these numbers in for you. You can always pause this video to write these numbers down. Now for the operating section. I have filled in the category headings for you. You just need to input the specific items. What was step one? Remember, we always start with our net income. We get this from the income statement. Let me go back there for a moment. If we look on the income statement, we can see net income is $10,500. This is the amount we will start with. We will input the $10,500 in the left column. The two columns don't mean debit or credit. We're just going to put everything in the operating section in the left column, then total it up and just put the total in the right-hand column. What comes after net income? We're going to add our non-cash expenses, which the only one in this course that we're going to focus on is depreciation. Remember, we can find depreciation two ways, one from the income statement, which is the better way to find it, or on the balance sheet. Let's go back and take a look at the income statement. If we take a look at the income statement, we can see that depreciation expense is $7,200. Also, if we look at accumulated depreciation, the difference between last year's and this year's number is $7,200 as well. On the next line, we're going to write in depreciation expense. And remember, depreciation has already been subtracted from net income, so we want to reverse that out by adding it. So we will add the $7,200. Next is the part that's a little bit trickier. We're going to look at our current assets and our current liabilities on the balance sheet. Look at the changes from last year to this year, and then either add or subtract those numbers. The part that I see students having the hardest problem with is knowing when to add or to subtract. So just try to come up with a way to memorize it, or at least memorize the assets and just know that the liabilities work the opposite as the assets. Let's take a look at the balance sheet. First, let's look at our current assets, but we're not going to look at cash because cash we use at the end. The total current assets would be these two items right here, accounts receivable and inventory. And then right below it, you can see they total it up. And then after that, it's a long-term assets. Remember that the current assets are basically like opposite. If it goes up in value, you want to subtract. If it goes down in value, you want to add. So if we look at the accounts receivable, it decreased from last year to this year by $2,100. What we want to do is add this number. Inventory, it increased from last year to this year by $19,950. Remember, we want to do the opposite for the current assets section. We will subtract that number. Now let's look at the current liabilities. We have accounts payable and salaries payable. When we're dealing with the liability section, it actually works in the same direction. If the amount had increased, we add it. If the amount decreased, we subtract it. Accounts payable has decreased by $1,500. We're going to keep it as is. We're going to subtract $1,500 in the operating section. Salaries payable decreased by $100 from last year to this year. We're going to keep this the same as a negative number. Therefore, we're going to put these 4 items in right now. First, we have our decrease in accounts receivable. Remember, that was a negative number, so we are going to add it here. Next, we have our increase in inventory. Since inventory increased, we're going to subtract that number. Next, we have our decrease in accounts payable. Remember, this is the current liabilities. A decrease means a negative sign. Lastly, we have our decrease in salaries payable. Since it's negative, we keep it negative of $100. Those are the items that go in the operating section. The last thing to do is to total up this whole left-hand side column and then put the total on the right-hand side. When you total this column up, you should get negative $1,750. Don't forget to include the net income number. I see a lot of students who add everything up except for net income, but that's part of it. So make sure to include the entire column.